trading. Okay. So we learned what futures trading are, the basics. We also learned some terminologies and the rest, and also how to use the candlesticks and know what they are used for, the time frames and everything.
That's good. Okay, so we have one of our brother in our midst who was not in our previous class. His name is Joshua, right? So, Mr. Joshua, you are welcome. Okay, so just for a recap, last class, which was on Monday, we actually talked about some the basics and introduction, like all of you have said. We discussed those things. Right? So we'll be continuing from where we stopped last week. Okay, starting from where we stopped last week. So I'm just going to share my screen. Okay. Yes, sir. Okay, verify if you can see my screen, please.
Can see your screen.
I can see your screen.
Okay, you can see my screen.
Yes, yes.
All right. All right. Okay, so yesterday, or rather Monday, we we talked about understanding the financial market, right? So today we will continue from the two topics. There are two topics that we'll be talking about today. It's inside the course curriculum I've sent on the group. So the first are market participants or the market makers, right? So let's talk about the market makers. Now, it is true that everything that you see is being made by someone, right? The vehicle that we drive today, somebody manufactured it. The how is it called? The AC you are using, literally everything upon this earth that we use for our comfort was made or manufactured by someone. Is that correct? So in that same vein, the market is made by people. When we mean market makers, we are talking about the forces that drive the market, right? So we are referring to the forces that drive the market, okay? So now, the first force that drive the market are the individuals. Are you still there?
Yes, yes, sir.
Yes, sir.
So all right. So the first force that drive the market, they are called retail traders, right? And that's the category you and I fall into. Now, a retail trader is an individual investor or a small capital owner or a diverse strategist, right? So when we talk about individual investors, what we mean is, please mute your mic if you are not talking. Individual investors, we are referring to all retail traders who are individuals, right? So they buy and sell currencies or securities for their own accounts. So you as a person, you can create a forex or you can create a Bybit account, a Binance account, or any BitGet, any other trading platform, and you can literally deposit your own money inside and start trading. That makes you an individual investor. Now, for the fact that you are in the market, there is a significant impact your activity in that market will cause, right? So for that purpose, you are part of the people that what make the market who it is. You just remember that this future trading we are talking about is actually being driven by someone. So if you are saying that this market is going to buy, going to be a bullish market, now you are saying that based on your analysis, other investors are also going to say, okay, this market is going to be bullish. For that purpose, they are going to put their money. Now, if the people who agree for the market to be bullish are greater than the people who agree for the market to be bearish, what happens is that the market begins to rise upward. Why? The makers have agreed that the market is going upward, right? So individual investors like you and I, who just deposit our own capital to trade and start buying, maybe start trading the futures. They are referred to individual traders. Then we also have small capital traders. They are all under category of retail traders. They call them retail traders. So whether you refer to them as individuals, small capital owners, or diverse strategies, they are all under what? In retail traders. They are called retail traders because they perform day-to-day trading. Just like your retailers, you go to a provision shop, the provision shop opens every day, and as it's open every day, there are retail people that buy small quantity. Maybe you want to buy 15 naira mangi, you want to buy 1 pack of salt, you want to buy all those petty things. They go to the retail shop. They don't go to the manufacturer. You get the difference. So they are called retail traders because day by day they are visiting the market. They are visiting the market every day with their small capital. They have. By small capital, we mean anything lower than $100,000. Yes, anything lower than $100,000 is referred to as small in the future market. So these people, they go to the market every day with the purpose of making a profit out of it. Day by day, they are visiting the market. Day by day, they are visiting the market. They are called what? Retail traders. Then we have the next participants, which are the institutions. Now, the institutions refer to large organizations, right? They have significant impact in the market. Why? Because they can pump huge amount of money to decide the direction of the market. So for the institutions, we are talking about institutions like banks. We are talking about institutions like hedge funds. We are talking about those mega institutions, right? They affect the market by pumping millions and billions of dollars inside the market to decide the direction the market should go, right? So how they do this is sometimes if they want to buy the market, they will first of all crash down the market. So let me give you a good example of what institutional traders do in the market. Like, remember many years back, we used to have Boa Cement, different elephants, and different other cements. Then Dangote came into the scene, right? Now, what Dangote did was he started crashing down his price of cement. So if others were selling cement at 5,000, then Dangote will be selling his own as 3,000 naira. So it became difficult for others to cope in the market because the price gap was too much. And if people were no longer patronizing them, now patronizing Dangote cement, and because they are patronizing Dangote cement, what now started happening is that these other people that have been in the market before started losing money, because for them to reduce their price to meet that of Dangote so that others can patronize them, we made them to even sell lower than their cost price. So for that reason, many of the industry folded up. Now, when all the industry folded up and Dangote was not in charge of the market, what did he do? He inflated the cement price. But at that time, nobody had a choice again because every other competitor is out of the market. That is exactly what institutions do in the future market. They will first of all crash down the price. So when the price is crashing down, they have a target of where they want the price to crash to. So because the price is crashing down, others who sees the price crashing that will be like, this market is bearish. Let's go in. Let's go in. So people start pumping money. People like the individual traders, the retail traders, they start pumping their money to go bearish in the market. Suddenly, the market will just turn and start going bullish. All these are manipulations of the institutional traders. They can pump in millions and dollars just to manipulate the direction of the market. That is why in trading, you must identify institutional zones. We will come to that in the course of the class. When you identify institutional zones, you go and wait for the institutional traders there, because that place, they will definitely come back to it. We refer to them as order blocks. Other people refer to them as fair value gaps. But all of them, I love to call them institutional zones. They are traps set by the institutions, the mega participants in the market, to take other people's money, right? So the next participant we have are what? Institutions. Then we have the market makers. These people involve the liquidity provider. For the fact that your broker can show you the chart is because there are liquidity providers. If liquidity providers should go extinct, trading will not be possible, because the only reason we can trade with our broker is because there is a liquidity provider who is giving them real-time feedback in the chart, right? So market makers provide liquidity, which is the chart that you see, those things you see on your chart moving and all that, they are referred to as liquidity, right? So then they also facilitate trading, right? Such as giving spread. They are the one that profit from the spread. When we come to go to the chart, I will show you what spread is. Market makers also facilitate trading. They help others to be able to execute trade. So without the market makers, you cannot execute your trade, right? So the quote, like quick feedback, if there is any change, when you see the candlestick moving up and down, going up and down, it's called what? The market makers are the ones providing that real-time response. That is why you can see that happening. All right. So the next participants are the market makers. Now we have three main participants when it comes to the forex market. We have the retail traders, which involve individuals, involve small businesses, we involve microfinance banks, all these people that have lower than $100,000 in the market, they are referred to as retail traders. Then we have institutions such as banks, such as hedge funds, and other mega investment companies. They are called institutions, right? They are the people that literally decide the direction of the market. A good example of institutional trader will be, using Nigeria as a case study, will be the central bank. Now, the central bank is the one that decides how much money is released per day to the masses. That is how the institutions also decide which direction the market goes per day, right? So then we have the market makers. These are the people that provide liquidity, and they also help facilitate trading and provide real-time quotes of the market condition. Any questions so far?
No.
All right. Okay, in the absence of any questions, so we'll be going to
I have a question.
trading terminologies.
Hello, sir.
Yes,
I have a question.
go ahead.
You said in the market participants, institutions.
Yes.
I wrote down, you said professional expertise. How does that relate to institutions?
I said what?
Professional expertise in your notes.
Professional expertise.
Yes, under institutions in market participants.
Okay, no. What you see under it is an explanation, right? Now,
Okay.
by professional expertise, I mean that they employ professional money management, right? So they are the market maker participant here is the institutions. These three columns you see under is just explaining what institutions do. For example, they are large-scale investors, right? Institutions manage money for others. So I can take my money to the bank. The bank will trade with my money and with profit in mind. Example of a large-scale or institutional traders involve the mutual funds and the pension funds. We all know these things. Then we have significant impact. The institution have significant impact in the trade because they trade with large funds. Their actions can affect the market price. So what you see under is just explanation of what institutions do.
Okay, sir. All right.
Do you understand now?
Yes.
Then
Yes,
this
sir.
professional expertise, I said they employ professional money managers. They don't just employ anybody. They will make sure that anybody they are employing is somebody that have a track record of managing money well. Because most of these institutions, they are dealing with people's money, not even their personal funds. Like hedge funds, they trade with people's money with the promise of giving you a percentage return over a period of time, right? And these institutions, they do a lot of research and analysis before entering their trade. The emphasis you should take here is that their impact in the market, their activities in the market can affect the price of the market. Because when we go to the chart, I will show you what that means when we get to the chart, right? But is this clear now?
Yes. I get to know.
Very
Okay.
clear.
Then we have trading terms, right? Terminologies. So now, when it comes to terms or terminology, you know, when we were in school, our department, we can literally gossip about someone without the person knowing. Joshua will understand. Sometimes we can be using the terms of our department to judge someone. For example, we can tell somebody that the person is really beat has won out. We normally use it to insult one another. Now, other people that are outside our department will not understand what we are discussing, but we know what we are talking about. So now, when it comes to trading, there are also terms that if you are not conversant with the trading environment, you will not know what people are talking about, right? So some of the terms is what we want to discuss. And one of them here is asset, right? Asset, of course, we all know what asset is, even outside trading world. We know that asset is anything you own that gives you money in return, right? So we know the concept of asset and liability. However, in futures trading or trading in the financial market generally, an asset is any resource that is owned by a company or individual and can be used to generate future economic profits. So now what does that mean? I create my account with Bybit. Then I funded $100. My entire asset with Bybit is $100. Why is it an asset? Because I can use that money to generate future profits. So I can turn that $100 to 200. I can turn the 200 to 300, right? So you in your crypto trading, you will see assets. The asset will not tell you the overall money you have in all your different wallets inside that crypto space, right? They are referred to assets. Anything you own that can be used to generate future profit is referred to assets, right? Then we have equities. Now, equity represents ownership in a company, right? So if I want to trade on maybe Meta, right? Now, if I buy some shares from Meta, now I have equity in the Meta, right? This concept of equities is usually in the stock market, right? You can buy stock, you can exchange stocks and all that. So equity is your ownership in a company. So you can buy shares. You can say I have 2 shares in the with the stock market. I have 5 shares. I have this. All those things are referred to as what? Equities. And then we have bonds. Bonds refer to what? Debt securities insured by corporations or government. Bonds pay interest over a specified what? Period. These are terms for what? For forex traders and all these stock traders. Our major concern is crypto here, but it's good that you still have some good idea of it. Then we have orders, right? Another trading terminology is orders. Now, an order, we have three different types of order. We have market order, which is executed immediately. So when we post signals, you will see sometimes we will put it market order. Market order means enter the trade now. That's what it means. Executed immediately at the best available price, quickest way to buy or sell. That is what market order. It is immediate execution. Then we have limit order. The limit order involves either you are buying or you are selling at a specified price or better. Order may not be what feed if price isn't reached. So let's go to our chart. Our chart, okay. Let's open up our chart. So let's when we talk about limit order, limit order is simply we waiting for the price to get to a particular point before we enter it, right? We don't want to jump into the market just yet. We want to wait, market the price, then we want to enter it. That is what limit order is. And if the market does not get to that point, then that trade will not be executed. It means that we have lost that what? Entry. It means we have lost that particular entry, right? So let me hold on, trying to load up something here.
No, I have a question.
Okay, you have a question? Okay.
Okay, my question is what you just said now concerning the limit order. That
What?
can you hear me?
I can hear you. What did you say your question is?
My question is on the limit order. That
Limit order.
what you just said now, that if you place a limit order and the market, the price did not get to that entry price you placed, that means you have lost the order, or you have lost that price. Does that in any way affect your money?
No, it does not affect your money. Your money, the trade did not execute, so your money cannot go with it. Right? Okay. Can you see my screen? Confirm if you
Yes.
can see my screen, so I will explain to you.
Yes,
Yes,
yes.
I can see.
All right. So to answer your question, Debbie, this is what we mean. So this is a 1 hour time frame chart of Bitcoin, right? This is Bitcoin USD, and we want to place trade on this market. Now, we don't want to enter the market immediately. We hope that, okay, this market perhaps will come down, and when it comes down, we want to enter it at a particular price. So what we want to do now is we want to say, okay, if this market should return to maybe, let me bring out some, okay. let's draw. Let's say, okay, we want the market to get to this point. Let's say we want the market to get to this point before we can take any order, just for an example. Now you can see that here we have placed an order here that when the market comes here, we want to execute an entry. We want to take a long entry and we'll target this point and put our stop loss just below here. Okay. So from here, let's say we are using $50 to enter this market, meaning we are risking $50. And if this is 1-to-3, a ratio of 3, so we are risking $50 to get $150. If the market should get to our take profit, we will get $150. But if it comes to our stop loss, we are going to lose $50, right? Now, as long as this market have not been activated, we cannot lose our money. The only way our money can go is if the market should come, activate our entry, and touch our stop loss. But as long as this market refuses to come here, then we can refer to this market that, okay, we have missed this entry. Now, let me give you, let me just give you something like this. So let's say we are saying this is our take profit zone. And we are saying that if the market should pass here and go or break upward, then there is no point taking this entry again. We'll just exit. However, what we want the market to do for us is to come down like this to this point, right? Activate this our trade. Activate our trade. So we want you to activate the trade like this and maybe give us some move like this. It can even come down, then break out of this point, and maybe retest, and boom, up we go, right? So this is what we are looking for the market to behave before we can take this entry. So now, looking at this, if the market does not come down to this point, we cannot lose our money and we cannot make any profits, right? So that is why it is called limit order. It is a limit order because you are waiting for the market. It is not something you execute immediately, right? Instant execution will involve us taking an entry from here and saying we want to take profit here and our stop loss should be here. So we just take the entry immediately, hoping for the market to start going to our direction. So this one is called immediate or instant execution. However, this one that we are waiting for the market to return to a particular zone before we can enter is referred to as what? Limit order. So for a limit order, you cannot lose your money if the price does not what? Does not activate your trade. So when we are trading, we have the limit order, right? Which is this one. And the limit order can be either a buy stop, a sell stop, buy limit, or a sell limit, right? So let me explain those terms. First, we have buy stop. So this trade, let me delete everything, delete all the drawings. Okay, so a buy stop, the first one I want to explain now is a buy stop. So the market is moving upward, right? Market is moving upward, but there is a zone that is very strong for the market to break. So let's take this zone to be that zone. So this zone have become a strong resistance to the market. So you can see the market came, it was rejected, it came again, it was rejected, and now it has come and we are seeing another rejection from this zone. So this zone becomes a resistance zone, right? Now, we are saying that this market is bullish, meaning it's still going to buy. However, we don't want to enter it yet because of this zone. So what we want to do is we want to place an order ahead like this. We want to say, okay, this new this will be buy stop, right? So this is going to be a buy stop. So we are saying that, okay, once this entry, if the market should go up like this and break from this zone, they are going up, then when it gets to our buy stop, it's going to activate the buy stop, meaning that it's going to activate our trade for a buy. That's what it means. So we don't want to wait for it at the bottom. We want to wait for it at the top. And we are not saying that if you get to the top, drop. We are saying that when you activate, keep going up. That is what we mean by buy stop. Any confusion?
Guys, what you mean is that the trade will be activated from under. As the thing is, as the trade is going up from under, to just activate from under and continue going up, not from up coming down again to activate it. It's just from under and going up.
Exactly. It will activate and keep going up. Yes, it will activate and keep going up. That is what we mean by buy stop. So if you are setting a buy stop, you are saying that if the market should get to that point, it will activate your trade and it will keep going up. You are setting that once the market gets to that point, there is nothing bringing that market down again. You are setting, so you put a buy stop. So when the market literally gets to that place, it will activate your trade and still keep going up, then you are profiting. But if the market should activate your trade and come down, so let's say we put our buy stop here and we take profit like this and put our stop loss below the zone that it's coming from. We believe it will not break down. So if this market should continue upward like this and going up, so let me just draw it the way market normally moves. All right, so let's say market, hold on, let me delete this. So the market now moves like this, Now, at this point, your stop loss, you are not at loss because it has not activated your trade here. You understand? So if the market should now move upward like this and break this point. Now, at this point here, the market have activated your entry because it has gotten to the point where you place your buy stop. So if the market should still come down like this, if it should touch this point, then you will lose your money, right? But as long as it does not touch and maybe it retraces back a bit like this and goes up and comes down again, and then boom. Yes, this one, you have made a profit from the market. I hope you understand now.
Yes, sir.
Yes, that's what it means for a buy stop. A buy stop means that activate and continue in buying. So when we put a buy stop order, we are telling the market that as you are activating this market, we expect you to continue buying and not sell. So if that actually happens, that okay, the market comes, activated our order and kept going up until our take profit, then this is a winning trade. However, if the market should activate and then drop to your stop loss, then that is when you will lose your what? Your money. Any questions so far?
Yes, I have a question.
Okay, go ahead.
So you are saying that because going to your charts, you say the buy stop order, that line. So are you saying that once the market crosses that particular price that the line is, to start buying, Abi?
That's what, when you put a buy stop order, that is what you are saying that the market should do for you. You are saying based on your analysis, when the market crosses that line, you should just keep buying. Take note, it's not this your buy stop line. You are talking about this line below here, right? You are saying if the market should cross this line, it means that it has broken out of this resistance. Then it had momentum to buy. So you are saying, but you want it to go a bit higher. So now when it gets to this your line, it will activate your trade for you. The moment your trade is activated, you are saying that you expect this market to keep buying once it crosses to this point. That's what buy stop means.
Okay, now I understand. Yes.
Right. Any
Thank
other
you.
question? Go for continue. Okay, I'll take that as no other question. So continue. Now let's delete everything. And okay, so the next one is what sell stop, right? Now sell stop is just the opposite of buy stop. For buy stop, you are saying that if the market should get to a particular price, then it should continue buying. For sell stop, you are saying if the market should get to a particular price, it should continue what? Selling. So both are just opposite of each other. So for example, if I say this market is going to sell, but I don't want to enter it here because it's too risky. I want it to break a particular zone. Perhaps maybe I'm targeting this zone, saying that, okay, this market should break this zone. Once this zone is broken, then I want to take the entry, right? Then I can put my entry maybe around here and say, okay, when the market gets to this point, it should what? Start selling for me. So I'll put my entry here and target maybe 1 to 2. I'll put my stop loss just below like this. So now what will happen is this. When this market now comes down, as it keeps coming down, so it will come like this. If it does not break this line and continue going up, you have not lost anything. But if it should come and maybe move like this and then enter, at this point, your trade have been activated because it has entered inside your entry point. Now, if it continues going like this, and maybe like this, you see that you have made profit, right? But if it should come to your stop loss zone, that is when you will lose the money. So what you are saying is sell stop simply means that if the market, you expect the market to sell the moment it gets to this particular price. Now, why do we call them limit orders? Take note that the current market price is here, right? This is the current market price. This part is the current market price. This point here, where this red candle is, right? Now this blue green candle that just opened, this is the current market price. You can see the current market price from these numbers that are changing from red to blue and all that. This is the current market price. But now we are saying if the market should crash down to this point, we want to take a sell trade. That's what sell stop means. So if the market should crash down to this point here, we want to take a sell trade, meaning we expect the market to keep crashing if it eventually gets to this zone. That is what sell stop means. It's just the opposite of buy stop. I hope it's clear.
Yes,
Yes, for me.
Understood, sir.
So now let's talk about buy limit and sell limit. So why buy stop and sell stop? You are waiting for the market at a point and you expect the market to just continue going when it gets to that. The buy limit is opposite of such. So if for your buy limit, you are saying, I'm waiting for the market to get to a particular price like this. Saying I expect the market to get to maybe a point like this, and what I expect the market to do is to come down, then start going up, right? So you expect that when the market comes down to this point, it should immediately start going up again. That is what buy limit is. So buy limit is so that you can buy it from that point. So, and for buy limit, you are waiting for the market at a lower price. Remember, buy stop, we waited for the market at price. But for buy limit, you are waiting for the market at a lower price, right? So you are waiting for the market at a lower price. You want to buy it from a lower price. It's just like you saying, I will not buy this phone today. It will be cheaper next month, so I will wait. That's what it means. So you look at the entry here, you say, no, I will not take the entry here because this point does not look juicy and there's too much trap here. I'm going to wait for the price to drop to this point, then I will take my entry. If I wait and the price does not get to this point, then I have missed that entry. But if it eventually gets to this point, then it will activate my entry. And if it should buy as I have predicted, I will make profit from the market. That's what buy limit is. On the other hand, sell limit is just the opposite, right? We are waiting for the market at a higher price. So let's say this is the market now. We want to say, okay, you know what? We want to enter this market, but not now. We want the market to maybe take out this high. And if we have a point that we are looking at, so let's take the chart downward, and you can see that there are points, right? We have a good point here that the market is likely to respect. So we can expect that the market is likely to do something like this, come up, then deplete a bit without breaking above it, deplete a bit. Then from that depletion, it will start crashing down, right? We can expect the market to behave like that. We can also expect the market to perhaps get to just this point, this particular point here. And when it gets to this point, it will also start crashing down. But now, all these points that we have marked, we may not be online to monitor the market as at when it gets to that point. And we don't want to miss the entry either. So what do? We take our limit order, we place it here. So you can place it here and put your stop loss maybe somewhere around here and target anywhere you want to target based on your analysis, maybe 1 to 2 or 1 to 3. Then we can take another entry and put it at this point too, right? So now we have 2 entries. What are we doing here? We are saying that, okay, we will not be online to keep track of this entry. But if the market should get to this point, we want to sell. So here now becomes sell limit, right? We now call this zone our sell limit. So we are saying that this is the zone we want to enter for a sell. So if the market should get to this zone, we start selling downward. And if this one does not work, if it gets to this zone, it should start selling downward, right? Now, what we just did is called sell limit. We are actually telling the market that we are going to sell when you get to any of this zone that we believe the market is supposed to crash from. So if we believe that the market will crash from here, we put our sell zone here, a sell limit. If we believe that the market is going to crash from here, we put our sell limit here. So when the market gets to that zone and it actually comes down, it's a win for us. But if it goes up, then we now take the loss. And if it gets to this point and maybe it comes down, then we recover the previous loss and also have a win. But if both should fail, then we have taken 2 losses from 1 trade. That's why you must manage your risk well. So instead of taking multiple entry, you can just take one. After your analysis, you can take the one that you believe will hold. But I'm just giving you example that for your sell limit, you are taking entries, higher entries. You are expecting that when the market gets to this point, people are going to say, no, this thing has become too expensive, so it will drop. People will start dropping the price. So that's the point that they want to start dropping the price is where you want to take your entry from, and it is called sell limit. Buy limit is just the opposite. Buy limit, we are looking for the price at a lower zone so that we can buy it upward. While the sell limit, we are looking for the price at a higher zone so that we can sell it downward. Any question?
For me, I'm okay, sir. I understand.
I understand it. I've taken it.
All right.
Understood.
Okay. Okay. So we all are on same page then. So now let's continue from here. So we have discussed the limit order. Then we also have stop loss order, right? You sell when the price reaches a certain level, limits potential losses on the position. Is what I just explained. Stop loss orders is this point that we say if the market should get here, pull us out of the market. We are no longer interested. The market has gone against us. So stop loss orders are very essential when you are trading, because if you don't use stop loss, most people don't use stop loss. They call themselves the stop loss, the no stop loss gang, right? It is a risky thing to trade without a stop loss. Trading without a stop loss is like living in a house without a roof. If the rain should start falling, everything you have labored to buy in that house, your furniture, your TV, electronics, your food stuff, everything inside that house, including you, is guaranteed to. You will not be spoiled because obviously you are not a commodity, but you will get wet, and chances that you will be very cold. And if it's some people that have tender body, that cold will lead to something else. But all your furniture and everything will get spoiled. Your food stuff will get spoiled. Everything will go bad. Why? There is no roof in that house to protect you from the rain. So the entire rain fell on your house, and the house, even the house will just be flooded and all that, will be swimming on water. That is what it means to trade without a stop loss. When you trade with no stop loss, the moment the market is aggressive against you, there is nothing to protect you. So if it hits it will hit your trade, it will hit your entry, it will hit everything, take you out all the money you have in your account. So if you have $1,000 and you don't have a stop loss, if the market should keep going down, if the market is going down to $5,000 downwards against you, you will definitely crash your account because it will lose all your money and everything. But if your stop loss is in $100, if your stop loss is in $100, right? What happens is that when it gets to $100, it will cut, it will shield you out of the market. So you will still have $900 to trade again so that you can reduce your losses, right? And when you enter another trade another time and it hits your take profits, you can recover your loss and even make profit. But if you don't have stop loss, one entry can take all your entire money, and you will not have another money to trade next time until you fund again. So trading without a stop loss is a risk. It's like gambling. There is no guarantee of return. So, right? It's a 50-50 chance. All right. So then we also have some other terminologies like market sentiment. We have technical analysis, which is what we will be doing, analyzing the charts to know the direction of the market. Then we have fundamental analysis. Fundamental analysis is very vital. Why? Because it is what we use. Most times we use the fundamental analysis like the GDP and the employment rate, NFP news, all these things, they affect the future market. And you need to analyze them to know, okay, why is this thing? If there is a particular news in a particular country, what impact will that news have on the future market? These are fundamental analysis. If the employment rate of a country should drop, what impact will it have on the future market? They are all fundamental analysis. Fundamental analysis is you using the condition of the country or countries that trade that future pair more. They are using the condition of that country to judge what might likely affect that pair, right? So if you are trading Bitcoin against the US dollar, chances are anything that affects the US market is going to affect the dollar, and anything that affects the dollar is going to affect the movement between those two pairs when you are trading them. So it becomes wise for you to keep track of the news. Technical analysis is just you using the chart, analyzing the chart, price action, smart money concept, every other concept that you want to use to analyze the market and decide which direction the market is going, right? Why market sentiment is just, is this market going to, are there more buyers in the market or more sellers? Is the sellers and the buyers, they're in a serious heat in the market? Because if they are a serious heat, the market will be in a ranging market because there is no decision. The buyers are saying no, the sellers are saying no, so nobody is winning and the market will just be ranging. But if the buyers are stronger, then the market will become a bullish market. If the sellers are stronger, the market becomes a bearish market. That is what we refer to as market sentiment. Then we also have risk management, right? Risk management. All these ones that I talked about, they are under what? Analysis. Everything that I spoke about, market sentiment, technical analysis, and fundamental analysis, they are all under as they call analysis, right? Then we have risk management. Risk management involves diversification, involves position sizing and stop loss, right? Putting stop loss orders. So when we talk about diversification, you want to ask yourself, are you, these futures that you want to trade, okay, are you going to be trading only one particular pair of futures? Are you going to stick to Ethereum? Are you going to stick to USDT? Are you going to stick to Bitcoin? Or you want to trade multiple pairs? Are you going to trade with just one account, or you will have multiple accounts? It's called diversification, putting trading more than one pair, one future pair. That is diversification. Then we have position sizing, ensuring that you use the right lot size so that you don't crash your account. There is a lot size you will use. As soon as you are executing that trade, your entire account will just crash down. The margin call you will receive a margin call immediately, right? Then stop loss order, which I discussed in the previous slide. And risk management is crucial because that is what you use to protect your capital profits. Why? Because if you protect your capital today in futures, in forex, in stock, it is more important to protect your capital. Why? Because if you don't protect your capital, you will not see capital to trade tomorrow. So imagine I have maybe a $1,000 account and I decided to risk the entire $1,000. Now, if that trade should go south, what will happen is that I will not have money to trade tomorrow. I'll go and look for another money to deposit. But if I decide that no, I want to risk 200. So if I risk that 200 and the market didn't go as planned and I lose that 200, I still have 800 to trade. And in that 800, there are chances that as long as I have good strategy, there is 70 to 80% chance I will recover the $1,000 back to you and keep making profits. But if I risk everything, I will not have money to trade tomorrow, even if I see a good setup and a very good opportunity to make money. I will not have money to enter. So protecting your capital is very important. Then we also have some other terms like volatility, which is the degree of price fluctuation. I showed you what volatility is on Monday when I was showing you the chart, the movement between the price fluctuation, right? So that as the price is fluctuating, you see 1, now you are seeing 5. Next time you are seeing it has gone to 20. So those things, they are what? Price fluctuation, they are called volatility. Then we have liquidity, right? Liquidity refers to the ease at which you can buy or sell your futures, right? And it will not affect the entire price. So if the rate of dollar is maybe you want to buy Bitcoin against US dollar and the rate is maybe $65,000 or $85,000 per Bitcoin, you can buy it and it will not affect you. Buying it will not make it to become 886 or 85,500. or 8,500 or even 85,000.1 cents. It will not affect it in any way. So that is what liquidity means, your ability to buy or sell without affecting the original price. Then we have leverage. Every broker gives leverage. So the reason, before now, trading was not open to everybody. Trading was mainly for the big boys, people that have a large capital. So because one entry is equivalent to $10,000. So people that don't have money don't normally do for trading generally. When trading started earlier. So most brokers now said, how do we not take this thing to the people that don't have such money? So they now come in with the concept of brokers. Now, a broker is the one that is communicating directly with the market while you are communicating with your broker. So Bybit is a broker, Binance is a broker, or Binance, anyhow they call it, is a broker, right? They are all brokers. They communicate direct with the market while you communicate with them. So they stand as a gap in the gap. So what happens is when you put your $1,000 or you put your $100 inside the market and you use maybe 0.01 or you use $10 to enter a particular entry, what you just did now is that you are trading with actually $100,000, because for every $1 you spend, the broker is spending 10,000 on your behalf. That is what leverage is. So you will see some broker will say we are giving 1 to 10 leverage, meaning that any money you deposit, they will multiply it in the back end by 10. So you will not see that it has been multiplied. You will only see it in your margin and your leverage. But in the back end, that is the money you have, and that is why you can place a trade. So in some brokers, you will see that the leverage is 1:1,000. It means that any money you deposit, they are multiplying it by 1,000 for you, and that will enable you to be able to trade with a good lot size. Then we have the spread, which is the difference between the bid and the ask price. Let me show you what we mean by that. So if we expand this, okay, so this is Bitcoin, right? So what we mean by spread, you see this current price that is counting here. This is our asking price. If you execute this trade in your live entry, or maybe you are using the MetaTrader 5, you are going to see another line. One of them is green, one of them is red. So the difference between those two lines is referred to us as spread. We will do that when you will see it when I show you, when we start doing our analysis, you will see it, right? Then we have margin, which is the amount you need to trade. So if you have $10 in your account, it's not enough to trade in the crypto market. If you have even $100, even up to $1,000, it's not enough to trade in the crypto market. But because your brokers gave you leverage, you can take that leverage, and you will now see, when you check your margin, you will discover that the money you have in your margin is way bigger than what you deposited. That is why you are able to place the trade. So your margin is how much you have, how much that is needed to open a trade, right? Then we also have, so those are some of the terms. We have talked about stop loss. We have talked about, okay, there's one that is called take profit that I think it's not added here. Now, a take profit order is you saying, I want to get out of the market at this point, right? So you are saying that when the market gets to this particular point, I'm done, I'm satisfied, let me leave the market. That is a take profit zone. Just like the stop loss is protecting you from losing your money, the take profit is protecting you from being greedy. The take profit protects you from being greedy and thereby losing all the profit you have made for the day, right? So these are some of the terms that you need to be conversant with. So now we have discussed some terminologies. We have discussed about the market makers. In our next class, which is on Friday, we are going to do some live session, right? We are going to do some live session together, and we are all these terms that we have discussed. You see us putting them to practice in real time, right? But that will be on Friday by 10 a.m. as well. Okay, so the class, this is the point where the class comes to an end for today. If you have any questions, this is the time to bring them. Yes, question time.
I have a question.
Yes, any question? Okay, go ahead.
Yes. Okay. The limit order and the stop loss order, you said there are differences. Yeah. So you said for limit order, when you have to wait for the lowest price when you want to order a buy limit, and you wait for the highest price when you want to order a sell limit. You hear me? Hello, can you hear me?
I can hear you. Go ahead.
Okay, yes. So the thing is that, what if in a situation where let's say you placed a buy limit, but still the price doesn't want to fall. So, and let's say eventually he hit that limit, but all of a sudden he went to sell again, but you press a buy limit. So and you put your stop loss maybe in a place that is very high because you have a higher belief and you're not online. So is there any way that you can cancel it without reaching the stop loss?
Yes, you can. When you place a trade and you discover that the thing is not going to, maybe your strategy has been violated along the line, and you find out that this trade is not going to work out again, all you need to do is to just cancel it. You don't need to wait for your stop loss all the time. If you are confident that this trade is not going to get to your take profit, it's heading directly to your stop loss, and you don't want to this. Let's say your stop loss is $50, and now the trade has gotten up to $20 loss, and you believe that it will still keep going down. It's not going to go up again, and you can cut it at that 20, and instead of losing the entire 50, you can just cut it at 20, and you will close from that trade. So it doesn't mean that once your market is executed, you must wait until it hits take profit or stop loss. No, you can close anytime you wish. Even you don't have to wait for take profit. If your market is going to take profit and you find out that this market is getting to a point where there is likely to be a reversal to the opposite side, it will not get to your take profit. So instead of losing the money you have made, you can just close it with this. So imagine that your take profit is supposed to be $150, and the thing is at 85 or 80 something, and now you see that the market has changed direction against your entry. You can close it at that 80 something and take that one instead of lose everything again to the market. So it's not wait, you can close it.
Okay. Is there any scenario where you can apply any of the market orders? Like, let's say when you're in this situation, use this to be safe. Is there any scenario like that?
Okay. So when talking about scenario, if you are doing your analysis, most times your analysis will not give you immediate entry. You will have to wait for it. You understand?
Yes,
So
yes.
while waiting for the market, if you are someone that maybe is busy doing other things, because there are people that stay with their screen. They can literally watch that trade from morning till night. They will not get tired. But if you are like the people that don't have that time to be watching the screen and seeing every single move of the market, then after your analysis will tell you which decision to take, either a buy limit, a sell limit, a sell stop, or a buy stop. It is your analysis that determines the decision to take. So there is no particular orchestrated scenario where you must take a particular action. Your analysis will determine that for you.
Okay, all right.
Yes.
All right. Thank
All
you.
right. Any other question? No problem. Okay, so in the absence of any question, this is where we bring the class to a close for today. We'll continue on Monday. Sorry, Friday.
Friday
Sorry?
for
Can't hear you.
Hello.
Yes.
I heard somebody ask me
You are asking if what? Okay, if you can use the demo account.
what is demo. Can you hear me?
What did you say, please?
Can you hear me?
Yeah, I can hear you now.
Okay, I said in the last class, somebody asked that for the live stream on Friday, are we going to use the demo account or your normal account? Like, what's the demo account? What do we require? What do we need for Friday?
Okay. All right. For the Friday class, since it's going to be a live session, we are going to be placing trades so that you can see, for those of you who are completely new, you can see how to place trade in the futures market, right? So now, what you need is an account with either Binance or any other futures broker that you are familiar with. If you don't have account yet, you can let me know. I will send a direct link to you so you can create the account. Then on that, just create the account down. That's all you need. Then on that Monday, Friday rather, on that Friday,
I can't hear you. Hello.
Maybe his network is bad. His network is bad, so he's going to join us.
Okay.
hear me now, right?
Yes.
All right.
I have
So
an
what I
account.
was saying,
Account.
okay, you already have an account.
Yes.
Okay, if you already have an account,